Okay. Burner Market Trading Group, this is I Can't Wait for It. And today we are going over Bollinger Bands Part 4. And we're going to be covering supply and demand and how that relates to the curve, Wyckoff's, stuff like that. Like again, we're just glimpsing, kind of getting into it. And I know there's a lot of text all over the screen, but I'm kind of going to try to break down everything so that you can kind of get a better understanding of what's going on in the market. So now, where we left off last week was there was a very bearish curve here, and it ended right here. And so then they rode the price action up and it waned off and couldn't create that higher high. And the whole goal was to drive price action down to run it back up to make twice as much money than they did on the last two previous moves. And so they run it up and they failed to do so here. And they noticed that there was a lot more volume on this run down. And so because there's a lot more volume on this run down or this, and volume as it's moving up, but it's not moving up, but the volume is increasing, that means that there's a lot of liquidity down here. And what is liquidity? Liquidity is a pool of open shares stop losses that lay below the current trend line. And so your current trend line is kind of like this area right here where price action hasn't, broken through. And so every time they break through, they're dipping into that liquidity to kind of gather and break those stop losses and gather up whatever extra shares they have and to get control of all those, of the float or the extra shares or all the shares. So that way it creates demand enough to where the leftover shares that are in the float that retail will have access to, retail will start to fight over those shares and drive the price action up. But if you don't have enough control over the float, then price action will not go up enough. And so that's what you'll see right here is they dip into liquidity, they try to drive the price action up, it doesn't go up high enough. They dip into the liquidity again, even deeper, and they drive it up again. It does go up a little bit higher, but again, it's not enough to break the previous high or even the higher high that they're trying to get to. So they start dumping off their shares, boom, 1, 2, 3, and drives the price action back down into a deeper pool of liquidity, an area that hasn't been tapped in a while because people think they're safe there. Boom, takes out all those stop losses, drives the bears, down, and you have fear of missing out. People jump, all the retail jumps in to try to drive even further, and then as it gets to an area where it is low enough to where they can start over again, they start buying up all those shares right here, hitting absorption. You can see on the volume accumulation line there that they tap that at 100%, which means that they hit absorption and they start buying it up. Actually, fear of missing out starts right here. They start buying it up right here and here and here, and they're finished right here. And retail is still jumping in to go short at this point right here. And so that's the difference between institutional buying and retail buying is that, institutional buying will actually, I've already started buying once retail actually starts to jump in to go down. And so price jumps up, it starts to move up again. They notice that again, you have 3 times to break for a new higher high after you hit absorption and it jumps up. And so you've got 1, 2, 3 times, and notice that it did not break a higher high, nor did it make any kind of momentum going up at all. It started weighing off, and so they went right into distribution mode again to dive into a deeper pool of liquidity, if you will. Boom, 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 come all the way down, get into this area down here, and now they are again soaking up the float and getting control of all the contracts or all the shares that are out there. And hopefully this time they have enough control over it that they can drive the price action up. And so as price action starts to move up, you'll see them sell off to give retail a chance to get in. They sell off, give retail a chance to get in. Notice that retail didn't go in as deep as they wanted to, so therefore they didn't sell off enough of their shares. They sell off twice as much shares and get twice as much reaction out of it. And so boom, it goes up. They sell off a couple more shares, runs up again, and So sell off more shares, and it runs up again, and then they keep, and so as they notice that it's starting to wane off and the amount that they're selling isn't enough to drive it up, then they sell off, 2, 3 times as much more, and then it gives retail a chance to jump in big, and then that drives the price all the way up. And so that finishes, you know, this movement for them. And most likely, if Monday comes around and, retail doesn't jump in and drive it up even higher, price action is probably going to end up dumping off right here. They're probably going to go into distribution mode and start this process all over again. But that finishes this, what they wanted to get out of this movement right here, because basically they got price down at, twice as low as what they were getting it at before, maybe even 3 times as low as what they were getting it at before, and getting 3 times as much out of what they were getting out of the previous movements that we covered in the last 2 series. And so you can see that, they were able to keep spurring price action down, and giving retail more shares to drive the price action up. And so basically they are, you know, uh, what is it called, when they are portioning out their shares and making profit as it goes up. And most likely, like I said, if this doesn't keep going up when they start business on Monday, they're most likely going to dump all their shares at this point to start that process all over again, because basically they've gotten what they needed to get out of this and have made the money that they needed to make, and 3 times as much. And so the mother load will be dropped right here, and you'll see a big difference between, you know these little dumps right here like this. You think that they ran out of shares by the time they get up here, but they're still holding on to a lot of shares. And you'll probably see something like this or even bigger when they release all those shares. All right, so that finishes up this episode, um, or this part, and of the Bollinger Bands and supply and demand. And hopefully that kind of gave you a better idea of what supply and demand was, and how it reacts, how the retail reacts to it, and how they use it in order to drive the price up or drive it down, to get cheaper shares. So if you got any questions, please write them in the comments below. Thanks again for tuning in, and I will see you on the next one.